Hi, everyone. I'm Garrett, and welcome to Class 8 Personal Finance Target Date Funds, part, or rather, take 4. This one's taken a while. This is my 4th attempt to record it. Hopefully, it doesn't go wrong. If you're watching it, it went okay. We'll see. Let's talk about target date funds and what they're for. A target date fund, such as, let's go to my screen here, this one. This is Vanguard's Target Retirement 2050 Fund. Why would you want a fund like this? What exactly are these target date funds? Should you use them? I've got the idea for this video from Rob Berger. That's this guy on the left here. He does a YouTube channel as well, and I can provide a link in the description of the video. And they've got some links here for best target date funds of April 2022. And take note, they're taking commissions on partner links on Forbes Advisor. So you should take some of these with a grain of salt, and I'll explain why in a moment. For one, you've got different expense ratios that you have to consider. The expense ratio on this Fidelity one is 0.12. It's the Fidelity Freedom Index 2060 fund. I'm going to go with 2050 funds just because I was born in 85 and I turned 65 in 2050. We'll also be able to see the fixed income holdings a little better that way also. We have Vanguard's fund here, which is 0.08. You have State Street, 0.09. And then you start getting to these actively managed funds, like American funds. I pretty much wince whenever I see that name. And here's one reason why. 0.71%. TIAA CREF, they make me wince too, 0.45%. Fidelity Freedom 2060 Fund, 0.75. Well, what's with that? I thought we saw a Fidelity one there already. Well, you go back up here and you note that this one says Fidelity Freedom Index 2060 Fund, and this one says Fidelity Freedom 2060 Fund, not index. This one's actively managed. You're paying some sub-advisors to pick and choose stocks on you. T. Rowe Price Retirement 2060 Fund, 0.64. I pretty much wouldn't go anywhere American funds and below in this list. Fidelity, Vanguard, State Street, these will probably do you just fine without my going in and checking all of the holdings. There's also a Schwab one that I'm surprised was left off the list. Schwab Target 2050 Index Fund, net expense ratio 0.08. I looked at the holdings on this one. I think it's going to do just fine. But let's do some holdings digging, and let's figure out what we're working with target funds in general. And in fact, let's talk about the concept a little more, and perhaps some advantages and disadvantages. So here's Schwab's glide path here. Now, a glide path is basically the plan on moving from stocks to bonds over time until you get to something close to your retirement date. And then here in the Schwab, it actually continues to build up fixed income until you have this final allocation of 28% stocks, 72% bonds. Now, this is one of those things about target date funds. When you're giving up control of the asset allocation to someone else, it may not be the asset allocation that you want. And so you have to think about whether that's going to be where you want it or whether you even care, whether you think, hey, I should put this in someone else's hands, especially if it's a behavioral issue. I had a nutrition professor in undergraduate who I think illustrates this well unintentionally. Somebody asked her whether it's okay to eat frozen vegetables instead of fresh vegetables. Like, okay, which one is better? And there's this whole debate about it, when they're frozen and whatnot. And the nutrition professor had some good wisdom. And she said, if eating frozen vegetables makes you eat vegetables, eat frozen vegetables. And you know what? If a target date fund makes you invest with discipline and puts it at an asset allocation that's reasonably close to where you ought to be, just use the target date fund, even if the fee is a little higher. Not the fee is a lot higher, but a little. And a 0.08, a 0.12, it's not going to kill you. If it makes your discipline better, it might result in a better return versus you're messing with the asset allocation based on your whims, based on your reading, financial media, and stuff like that. Let's go back to the screen here instead of my ugly face, and let's take a look at some of these funds. I want to take a look at Vanguard first because, one, it's the cheapest at only 0.08. You can see that right there. The minimum investment on these is $1,000. It used to be $3,000. They brought it down to $1,000 several years ago. So it's pretty easy to get into. Now, that said, what I'm also going to note is I don't recommend Vanguard in terms of their IT and customer support. And if you need to know why, just Google my name, Garrett O'Hara, then Vanguard, and you'll see why. I spoke with a journalist about this back in the day. By back in the day, I mean like August, not back in the day. Let's go to the portfolio here, and you can see what Vanguard does with these. Vanguard puts 4 funds only in their target retirement funds. It's a total stock market fund, that's US, a total international stock market fund, everywhere outside the US, a total bond market fund, and a total international bond market fund. And the bonds, this is a bit of a rounding error, I assume, comprise, you know what, actually, the asset allocation here and the date over here to the underlying funds, they're different. So just note that. But it's not a significant difference. 89% stocks, 10% bonds, 1% cash. So 89 to 10 on the ratio. And the litmus test I gave earlier in 2 other videos is that when you're talking about a stock to bond allocation, you don't want to have more than twice the stocks that you can afford to lose, or can stand to lose rather, in a crash. So since this is 89% stocks, let's call it 90% stocks just to make the math easy. In a 90% stock portfolio, if the stock market goes down by half in a drawdown or a crash, you lose 45% of the portfolio rather than 50%. If you have 80% stock portfolio, you lose 40% instead of the 45%. So think about in your own mind how much you can stand to lose. At what point would you start to exhibit bad behavior in terms of, hey, I'm just going to pull all the money out of the market because I'm scared, kind of thing. And if you were already invested in March 2020 when the COVID crash occurred, maybe you already have some experience with that, and you know how much you can tolerate, how much you can't. I started being more aggressive after the COVID crash myself because I figured out, hey, I was actually pretty disciplined to that whole thing. I can handle more of a hit. So let's go through these funds here. Let me go back to the screen. So you have these 4 funds here, and the question to ask in a Vanguard context is how much are you actually paying in comparison with these other funds? Now, I'm just going to say this off the top of my head because I don't want to lengthen this too much, but I'll show you how to look these up. So for Vanguard Total Stock Market Index Fund, that symbol happens to be VTI. So I can pull up VTI for the ETF, which is something that you can get at any brokerage, not just at Vanguard. And the expense ratio is 0.03. Really, it's less than that because they do stock share lending, and so they actually get some revenue from that. So it's effectively free exposure. It's effectively a free fund, but they still have to declare 0.03 in terms of how much they're taking for the expenses. For VXUS, that's the second fund there, the Total International Fund. I think that actually got reduced recently. Last time I looked at this, I think it was 0.07. And let's take a look at that and make sure we have it right. And indeed, it says 0.07 right here. The third fund there was BND. I guess I am looking them up, huh? BND was the Total U.S. Bond Index Fund. And that was 0.035. And then finally, BNDX is the Total International Bond ETF. And that's 0.07. So all 4 of those expense ratios were lower than the 0.12 that we saw for the target date fund. It was 0.08 for Vanguard for the target date fund. All 4 of those expense ratios for the ETF were lower. So by taking on the target date fund, you're purchasing a product. You're purchasing the computer basically doing this calculation for you. Human beings doing the calculation for you, really, and saying, hey, I want you to take over the asset allocation. I'm going to pay you a little bit of extra to do that. You're not buying full advice. You're not going to talk to a human being who guides you through exactly what to put in each percentage or something like that, but you at least have some sort of guide, and if you leave it alone for 5 years, it's going to still be guided through that rather than you stopping by every 6 months to a year to figure out if you want to rebalance or readjust something. And really, that might be something that you really, really want. Let's take a look at the Fidelity ones here, because I think this one is a pretty good study. So here's the Fidelity Freedom 2050 Fund. And to note, it's going to be different than the Fidelity Freedom. Let me switch back to the screen, O'Hara. So let me switch back to the Fidelity Freedom 2050 Fund right here. This one has an expense ratio of 0.75. So watch out for those expense ratios. Make sure you know what you're getting into. And then this Fidelity Freedom Index 2050 Fund is 0.12%, which is a lot lower. It's still a little higher than the Vanguard product, though. And note, you would have to open a Fidelity account for the most part to actually invest in either one of these. Now, let's take a look at the composition for each. It's called the Composition tab here on the Fidelity website. And, oh boy, this is a long list, is it not? Intrinsic Opportunities Fund, Growth Company Fund, Large Cap Stock Fund, Stock Selector, Large Cap Value Fund, Value Discovery Fund, blah, 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 blah. Who wants to go through all that? Really? I mean, I can see where they're kind of going with it. I mean, there's a commodity fund in there even. That's like gold and wood and pork bellies. You've got some developed markets equities there. What's the ratio there? It might be like about 1/3 of the equities look like they're. Oh no, see that's they're not. No, it's almost a 60-40 because you have U.S. equities 51.6%, non-U.S. equities 41.8%, and the bonds are 6.91%. So another thing to look for is with the asset allocation is how these things compare. This is not the same as the Vanguard one. This Vanguard one was like 89% stocks. Remember that? And over here with this Fidelity Freedom 2050 fund, not index, it's like 93% equities. Does 3% make all the difference in the world? Probably not, but in a crash, you might feel like it. And the bond allocation is, there's some other really weird stuff going on there that I'm not going to go too much into. Then you have this Fidelity Freedom Index 2050 fund, which is a lot simpler. Besides being 0.12%, U.S. equities, one fund, Fidelity Series Total Market Index Fund, which is basically the same thing as Vanguard's Total Stock Market Index Fund. You shouldn't see any difference between those two. You have this non-U.S. equity one, which is basically Vanguard's Total International. It's almost the same thing, I guarantee you. For the bonds, they actually split this out. They have the bond index fund and they have long-term treasuries. That's going to improve the credit rating of the bond portfolio, but it's going to also increase the interest rate risk. And I'll leave that there. And a very tiny, tiny amount dedicated to international developed markets. Nothing in there for emerging markets on the Fidelity side. So you've got these three right here. Now, let's say that, okay, you want to avoid the Vanguard IT customer support thing, but you still feel like, hey, this Fidelity one might be for me. Or, you know what, let's look at the Schwab one for a moment. I'm just going to go to the portfolio here. Say they've got a large cap ETF, an international equity ETF. Is this the index one? It is. Okay. So large cap international equity, aggregate bond was basically total U.S. bond markets, another way of saying the same thing pretty much. Emerging markets equity, so basically the international equity I assume is a CHF. I think that's developed markets, and then this emerging markets one. Developed markets, I've talked about this on the channel before. Developed markets are like Japan, United Kingdom, Germany. Emerging markets, China, India, Brazil, formerly Russia. Russia is no longer even an emerging market. They're considered a standalone. They've got an odd allocation here to real estate investment trusts, REITs, and a separate allocation to small cap. They separate the Test. Okay, we have our audio back. So yeah, in case you're wondering why that audio mixer is right there, it's because my microphone keeps dying. So if you know why that happens, please let me know. I think I caught this one in time though. So I'm just going to keep going and then hope this take works. But let's go back to the screen here, and we're going to take a look at both Fidelity funds. We're going to backtest FFFHX, which is Fidelity's active fund. And we're going to compare it to FIPFX, which is Fidelity's index fund. And we're also going to add Vanguard's VFIFX right there. And we're just going to see how they've performed as long as we're able to, because obviously they were incepted at different times. Vanguard and Fidelity incepted these in 2006. Fidelity got into the index target date business here in 2009. And so these are only going back to 2009, just to be fair across all three. And you can see, even if you want to say, okay, index funds outperform active managers, and yeah, in a general sense, that's true. In this case, with an initial balance of $10,000, the actively managed fund for Fidelity actually beat their own index fund. Now, when you're thinking about these expense ratios, here's what you're really saying. With a 0.75% expense ratio on Fidelity Freedom 2050 here, and a 0.12% expense ratio for Index 2050, by investing in the actively managed one, what you're basically saying is, I expect these active managers to beat the index portfolio by 0.63% per year on average. Is that going to be the case every year? It doesn't have to be the case every year. That's basically what you're saying when you're doing that. And here's the other thing you got to think about, and that is standard deviation. That's how much the portfolio is going up and down. That active portfolio went down, up and down more here, 13.16 versus the other two. And the way you can kind of synthesize that is with the Sharpe ratio or the Sortino ratio. Both of these are basically ways of figuring out how much standard deviation you had to take in order to get that return. And the Vanguard fund is the clear winner here. It had a higher return, and it even had a higher Sharpe ratio. The standard deviation was between the two Fidelity options that we have right here. But let's backtest this a little more and perhaps make it more realistic, because one, nobody just sticks $10,000 in a target date fund and then lets it go for 22 years or however long. You're probably buying into it over time, because you don't just have a lump sum sitting there and you're like, well, that's what I'm going to retire with, and then you just live on your income and never invest anything. And the other aspect there is, let's go ahead and go to the screen here and I'll explain this. We'll go to the backtest portfolio, and I'm going to say that this initial amount, let's say we started with $1,000 here. This is for like a brand new investor, and we're going to say cash flows, we're contributing a fixed amount. Let's just say $250 a month. We're not going just for inflation. Don't need to make this too complex. That would be the contribution being inflation adjusted. That's what that's talking about. My dog needs to be quiet. Hope that's not coming through. Contribution frequency monthly. We're contributing $250 a month, which is about $6,000 a year. And we're going to rebalance annually. Why would you rebalance a target date fund? Hold on for a sec. So let's say we're going to get rid of Fidelity's actively managed fund. And the point I wanted to make back here with the actively managed fund, if you had done the actively managed fund with a target date, would that completely derail you? Probably not, but it's just something you don't need to sign up for. That's my thought. But go back to this back test here, and let's put in Fidelity's index fund. I'm going to put in Vanguard's in, VFIFX. And then here's what I'm going to do. I'm going to put in my own. I'm going to kind of do my own thing here. I'm going to pick my own asset allocation and kind of play around with it. So let's say this is Fidelity index. This is Vanguard index. This is O'Hara's fund picks or whatnot. And I'm just going to construct about a 90-10 portfolio to sort of match what these two are doing. Now, here's the thing. Maybe I would not have picked a 90-10 portfolio. In fact, I've never had a 90-10 portfolio except when I had this Vanguard fund. Usually, right now, I'm like 80-20, and I'm 37 years old. But let's go ahead and do a 90-10 just to make it an even comparison. So VTI, right here, which is Vanguard's total stock market index fund. I'm going to put VXUS for now, just to make things as even as possible. I'm going to put BND, Vanguard's total bond market index fund. And this isn't exactly what I would do, but I'm just trying to make things even. And I'm going to go with a 60-40 portfolio. Actually, you know what? I'm going to go 70-30, which is more Vanguard's standard advice. I'm just going to go with that for now. So for the bonds, we're going to do 10. We're going to do 9. So 90% times. So going to be 90% stocks times 70. 9 times 7 is 63. Am I getting that right? 63. And then 26. I think I got that right. Yeah. Okay. It's going to be off by 1 due to rounding. Let's call that 27. Did I do that right? Let's do math. Sorry, guys. Should have planned this before. All right, here we go. So 0.90 times 0.70. I was right. 0.90 times 0.30. 27. Okay. I did it. Cool. Here we go. So let's see who wins. This is constrained back to February 2011, which is when VXUS was incepted. So I'm actually going to mess with this a little bit more. VGTSX, which is the oldest form of Vanguard's total international fund, just to keep things farther back, as far back as we can. And is that basically the same line? Because that looks like basically the same line. Let's see. O'Hara's fund picks wins. Compounded adjusted gross return 42.73. I beat the Vanguard fund by about under $4,000. The Sharpe ratio, I did it with a better Sharpe ratio, 0.82 versus 0.79. Now, hindsight being 2020, now what would I have been doing differently? What if I had picked a 60-40 portfolio? Because I believe in a 60-40 portfolio. By 60-40, I mean 60% US, 40% international. What if I had done that? Well, that's kind of what I did in previous takes. So let's go ahead and try it. 9 times 6 is 54. And 9 times 4 is 36. Does that add up? It does. We got that 100 there. What if I'd done a 60-40 portfolio? It looks like I've lost. I've lost to the Vanguard index by about $700. Fidelity was still a little lower, and I'm not sure of the whole history of that Fidelity index fund, so I'm not sure why it's still down like that, but it's not the end of the world. I mean, if you contributed $250 a month starting in end of 2009, and you had $73,000 at the end, you'd probably be pretty happy with it. But see, Vanguard also beat me with the 0.79 Sharpe ratio. The Sortino ratio, 1.25, beats mine as well. My Sharpe ratio is about the same as Fidelity. So, hey, I'm cool. I can work for Fidelity now. They're just down the street. So, yeah, when you're talking about target date funds, that's kind of what you're looking at. It's easy enough to kind of go in and do these back tests and kind of go, hey, I could do this just as fun as the other guys. I mean, here's the thing. Did you know that back in 2009 when you started investing, if you started investing back in 2009? No. And if you're starting off now, you don't know how the market is going to do for the next 10, 20 to 30 years. We have the right now we have the benefit of hindsight to go back into a backtest, kind of go, hey, if I had done, 100% U.S. stocks and 0% international plus however much in bonds, then I would have done this instead. That doesn't mean that's what you should do now. Let's add the Schwab one in here just for kicks. SWYMX. Let's go back to the screen here. SWYMX is Schwab's Target 2050 Index Fund. I'm going to replace the Vanguard one. See if I can beat Vanguard. Or replace the Fidelity one here. See if I can beat Vanguard. SWYMX. 100%. Let's give it a shot. This is fun. I'm not sure how fair this is going to be because Schwab didn't establish that fund until September 2016. But it's fun to look at. So starting September 2016, if you had put $250 in a month, Schwab wins. Or no, I named it Fidelity in there and I didn't change the label. Let's change that. Schwab Index right there. So Schwab Target Index 100%, and we go right here. And it's going to be the same numbers. I just wanted to make sure that this was clear to you, the viewer. It's about you. And Schwab slightly beat out Vanguard. Does that mean Schwab's like absolutely better than the Vanguard one? No. Would I trust Schwab's IT and technical support more than Vanguard? Yes, definitely. And so there's some decisions to be made here. But in the end, I mean, that previous line was basically one line there. And it roughly matched what I could do with just a normal 3-fund portfolio without, my small cap value tilt, whatnot. And I didn't want to go there because if you're considering a target date fund in the first place, then you're looking for simplicity. So one, you could be looking for simplicity. Two, you could be looking for behavior modification / improvement. Hey, I want to make sure that I'm not doing stupid stuff in my portfolio, so I'm going to hand it off, but I'm not going to hand it off to a high-fee financial advisor who's charged me 1% a year and making me sit in office like at Edward Jones or at a First Command or whatnot. And three, you want it to get safer over time. You can't customize everything here. Like, for example, when I build my portfolios, I leave China out of it. I pretty much don't have emerging markets other than the FRDM index ETF. It's not really an index. It's a strategy, but you get the idea. So that's the video. The other thing to think about with the target date funds is you go back to this glide path here. Let me go back to the screen. Other thing to think about with target date funds. So one is the simplicity, behavior modification. You're thinking about expense ratio, so they're going to be a little more expensive. This one is 0.08. That's actually, that just dawned on me. That's just as cheap as Vanguard. It is. Schwab's is just as cheap as Vanguard, which is awesome. And you have to think about this glide path here because you look at the target date, 44% stocks and 56% bonds. Is that going to be good enough? Because all the talk in the financial media right now is the 60-40 portfolio, and they're talking about 60% stocks, 40% bonds. Is that going to be good enough? This one's doing a 44.56, and it's going into a 28.72. So yes, it's a good lazy portfolio. Should you go in and check it every now and then? Probably. You should probably check it once a year just to kind of see where it's going and make an informed decision as to whether you want to continue with that. And by the way, you don't have to go with the exact date that you are retiring or when you turn 65 or whenever it is. If you think the 2050 fund, like this one here, is too aggressive, you can go find, let me just type it in. Schwab Target Date Fund 2040. And it even comes straight to the index fund, which is awesome. It's like they're tricking me. Test. Yeah, okay, I saw audio. So target 2040, the expense ratio is still 0.08. But let me see the portfolio. So I really shouldn't have done this one because Where's the bond? So it's like 15% bonds. That's pretty close to what I have. So I'm 80-20 in my allocation. But this one, the one bond fund there is 15.5. So let's just call it like about 85-15 or an 84-16 ratio between stocks and bonds. I think that's fair. So you don't even necessarily have to pick the date that's your date. You can go into the holdings and figure out, okay, I want this to be a little more conservative, or hey, I want to be a little more aggressive. And then you have to think about at the end there, okay, once you are actually retired, is this going to be a good mix, or do you have to think about something else? That doesn't throw target date funds completely under the bus, but it's something to think about. I like target date funds. I really do. Even though I don't do them myself, I think they're a good solution, and they kind of get poo-pooed on too much. They're good, solid investment for most folks, as long as you know how to look at the holdings, you know about the expense ratio, you know roughly what's going on inside them, and you know what to expect. So don't poo-poo target date funds. I think they're a great tool for a lot of investors. That's the video. My name's Garrett for Class 8 Personal Finance. Like, share, and subscribe if you enjoyed the video. And again, let me go back to this right here. 2872 during retirement, maybe a little too conservative there, but yeah, just keep an eye on it. Don't completely forget about it, but don't poo-poo it either.